Welcome, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, the most important hour of radio every Monday on 1580 The Big Talker. Thank you for joining me this afternoon. For those of you who don't know, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets one house at a time. Within every market, there are solutions as well as tremendous opportunities. You guys just need some trusted advice. That is my message, and I'll be delivering it to you guys every Monday from 2 to 3 p.m. right here on 1580 a.m. The Big Talker. We've got some great stuff lined up, great guests. First up, joining me on our panel is Louis Cammarosano, the general manager of HomeGain. You can check them out at homegain.com. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and many others. He's going to be here to help me discuss what's going on in the markets from last week, as well as where we see the real estate markets moving ahead. Later in the show, we're going to speak with Patrick Duffy with U.S. Realty Partners to get an update on the local real estate statistics for Prince William and Fairfax County. First up is Louis. Louis, you there?
I'm here, Ryan. How are you today?
I'm doing well. How was your weekend, Louis?
It was grand. And yourself?
Oh, can't complain. As long as it's nice and sunny outside. We actually got to venture out to my dad's pool for the weekend. Hung out there for a while, so it was pretty relaxing. Anytime you can relax when the weather is not raining outside is a positive for me.
Well, you're right. Nothing to complain about there. No one would listen anyway.
Yeah, exactly. So we got a lot of stuff going on, Louis. Want to jump in for a lot of the listeners. You sent me a great article this morning on America's richest counties, and amazingly enough, we're going to jump in that basically 4 out of the top 5 are actually within the Washington, D.C. metro area. We're going to cover that. Also, want to jump into the Case Schiller Index and how everybody's putting so much stock into this Case Schiller Index. I actually took the liberty this past weekend to really break that down and really see if it actually gives an accurate reading of where we actually stand right now today. So we're going to break that down for you guys. Also, we're going to continue our debate on buying versus renting, which is very important because the renting trends, rental prices have been trending upward for some time now. And also, are your credit scores costing you and your homeowner's insurance and car insurance thousands of dollars per year? We want to give you some helpful tips so that you can try to, cut those bills back. So, any questions before we get started? Make sure that you reach out to us on our off-air line. That's 877-245-2030. That's 877-245-2030. Just call that number and you'll be redirected to an off-air line, and I will personally advise you on anything. If it's housing related, credit related, financially related, just give us a call. It's 877-245-2030. Now we're going to jump into our Word on Wealth segment. This is where we're going to give you an overview of what happened last week in the market and how it impacts you, the consumer, financially. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. So go to homegain.com today to see what I'm talking about. All you have to do is type in your home address and you will get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. So when you get a chance, check that out. It's homegain.com. So let's start with what happened last Monday. Obviously, Monday was a holiday, Memorial Day, where we remember to honor those who have served and continue to serve our country. It's a crazy world we live in, but because of these men and women, we're able to remain safe. So I just want to give another shout out to all the men and women that serve our country so proudly. On Tuesday, mortgage rates hit record lows for the year. Louis, you and I keep saying they're not going to go any lower, and it seems like every week they keep inching a little bit lower.
That's true.
Which is a good thing for the consumer out there. I mean, I'm glad we're wrong, to be honest with you. It's not something that is sustainable. Obviously, we've talked about numerous times on the show, but for the consumer, for the first-time home buyer out there, for the move-up buyer, those that are looking to move out of a smaller home or a condo to move into a townhouse or a single family, it's a great opportunity right now. Not only to move into that home to get more space, but to protect yourself from the future inflation that is inevitable, that we've been preaching week in and week out. It's going to happen. It's just a matter of when. So, with low rates, typically, at least in the Washington, D.C. metro area, we've been seeing prices trend upward. And we're going to have Patrick Duffy, real estate agent with U.S. Realty Partners, on later to kind of discuss. I just wanted to break down where we were last year and where we are right now today, just to kind of get a year-over-year comparison to see in the Washington, D.C. metro area. So that'll be interesting to talk about that. But on Tuesday, the Case Schiller report was reported. And many people, the media especially, put tons and tons of stock into this Case Schiller index, which is basically the leading measure of U.S. home prices. And it showed that the National Home Price Index declined by 4.2% in the first quarter of 2011 after having fallen 3.6% in the fourth quarter of 2010. Now, Lewis, I don't know how much stock you put in this, but I believe that the Case Schiller Index does leave out a couple of important components for certain areas, especially bigger cities. They leave out co-ops, they leave out condos, and they leave out new construction. Now, in my area of Northern Virginia, D.C. metropolitan area, I think it's huge and critical because in a lot of these cities, we do have a lot of condo projects that are springing back up now. We do have a lot more new construction than the rest of the country, and I think that it's kind of giving a false sense of where we're at. Not to mention that I had a discussion with a colleague of mine that's out in Arizona, and Arizona is a very distressed area, in Maricopa County in particular. We were kind of going through the numbers over the weekend, and it was interesting because a lot of the home prices out there, I mean, you're talking $75,000 to $100,000. So you would think that, you've got all these distressed sales. I mean, obviously that's why home prices are coming down. They're, between short sales and foreclosures, your median home price tends to be trending down, but I think it's more because of those distressed sales. But that wasn't the important part of what I took away from it. The important part was that there was, of that, there was only a 2-month supply of houses on the market. These houses are selling, and they're selling quickly month over month. So it's interesting because even though we had this decline in the market, I think it's really because of the short sales and the foreclosures that are forcing that. It's still a healthy market. The home prices may not be, trending upward as fast as we want, but I think that it is a good indicator that if that is happening out in Arizona and we're seeing houses are moving, they're moving at lower sales prices, obviously, and the interest rates are contributing to that. But I think that, this Case Schiller index showing that, national prices are falling and trying to give like a false sense of what's going on is I think, actually hindering a lot of people from wanting to enter the market. What are your thoughts, Lewis?
One problem I have with the Case Schiller index is that it is retrospective. I believe that data goes back to, March?
Yes.
Doesn't give an accurate snapshot of what's happening now. And as you know, HomeGain completes a quarterly survey that asks homeowners and real estate agents where they think home prices are going. And what's interesting, though, Ryan, is I don't really have good news this time.
Uh-oh.
We have not yet published the results. They're just coming in from being sent out last week. But last quarter, this is nationwide data. Last quarter, in the first quarter, real estate agents, 39% of them thought that home prices would decrease, and homeowners, only 30% thought they would. And the general consensus between homeowners and real estate agents was that they would stay the same over the next 6 months. The preliminary data now shows that a large dose of pessimism has entered into the real estate agent's mind, with 57% thinking that home prices will decrease over the next 6 months, and only 33% thinking they'll stay the same, and only 10% thinking they'll increase. That's a big shift because generally the real estate agents have been over the last year or two slightly more pessimistic than homeowners, but this is a big difference so far. And of homeowners, 42% think they will decrease, 43% think they will stay the same, and only 15% think they will increase. So those numbers are for the first time also on the increase area in the the 10 to 20 range, when they've generally been in the 20 to 30% range.
Right.
So you're right. When you hear these statistics, and also, they're taking into account what they're seeing in the market, it doesn't lead to a very nice picture on the direction of home prices.
Absolutely.
And I don't think you'll change that until the circumstance you just mentioned in the areas where home prices have declined but are selling, until that inventory gets washed out, and then home prices begin to stabilize and go up. But until that happens, until you have all the shadow inventory and the foreclosures and the short sales on the market, that's keeping home prices down nationally. But as we can discuss later, totally different situation in the D.C. metro area.
Absolutely. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano, the general manager of HomeGain. Louis, what you said is interesting. Do you feel that because, you're obviously serving real estate agents and consumers, and I feel like there's very good links between the, the optimism or pessimism from the agent onto the actual consumer. Do you think that it's because that the media is pumping out and constantly talking about shadow inventories and distressed sales, which is all it casts a negative light on the industry as a whole? Because when people think of short sales and foreclosures, they think of prices that are lower. You know what I mean? And
yeah, market sentiment does play a role in pricing of houses, and obviously the media can influence that. However, it's similar to the concept of saying that commodities are going up because of speculators. If the underlying fundamentals are there for home prices to go up or commodities to go up, they'll go up or down based on that eventually over time. And you really can't the media can't really manipulate the housing market to convince people that the prices are overpriced or underpriced. And similarly, speculators can't make, other than short term, commodity prices go up or down.
Right.
The underlying fundamentals are the underlying fundamentals of the market, and eventually the market speaks louder than the media.
Yeah, and and like you said, we just have a different dynamic going on here in the Washington, D.C. metro area right now. The Case Schiller index, we're talking nationally, and you sent that article out on basically the top 10 richest counties in the country, which I think is very important because people in this area, I don't think sometimes understand how great of a place it is to live within this Washington, D.C. metropolitan area, because if we take, we count Maryland and part of that, metro area, there's 4 out of the top 5 richest counties actually in the country are, the first one is Howard County in Maryland. Number 4 is in New Jersey, so we'll exclude that one. The third one is Fairfax County. The second one is Loudoun County. And number 1 is Falls Church County, with the median annual household income of $113,313. And it's just amazing that 3 of the 5, Lewis, are just in this little area of Northern Virginia. I mean, it's like they really butt up against each other, really.
Well, it highlights that real estate is local, and you shouldn't take national statistics in mind when you're going to buy a house around the corner.
Exactly.
And in your area, in the D.C. metro area, you've got a confluence of very positive events. You have government spending, government contracts, government workers, all with pretty good job security. So you have a lot of dual income earners there, and they can buy houses, and the housing market is tight there, so the prices are stable or going up.
Yeah, and what was interesting, because we'll move ahead to what happened. Well, last Wednesday, the ADP of private sector jobs report came out, and it bombed. 170,000 jobs were expected, and only 38,000 were created, which is not good. It was a big downturn for the market. Bonds were off to the races, and there was, it's creating even more opportunities for refinance. For those of you who've been sitting on the sidelines and saying, well, I'm just going to wait until it gets down to, 4.5% or 4.25%. They are close to those levels. Bankrate.com is showing rates around average about on a 30-year fix about 4.55%. Now remember, these are averages based upon Bankrate, and you need to qualify. It's based upon your loan to value, your credit scores, and numerous other indicators. But whenever you're shopping for a mortgage, make sure you are looking at your actual APR, because that's the important calculation to be able to measure one loan against another. But with that being said, I think that it is important for people that are thinking about, even if you're looking to just refinance to take out cash to do renovations to your current home, that you really do that now. Don't wait. If you're thinking about it now and thinking, maybe we'll do that in a year or two, you maybe want to go back and think about that again today and say, you know what, well, we might need the cash in a year, but we're not going to be able to borrow it necessarily at the same rate that it is at today.
Good point. Have you seen the 15-year mortgages? They're citing a lot of those lately. They're under 4%.
They're under 4%, yeah. And like I said, everything is based upon what your loan to value is and credit score. And Lewis, it's interesting you bring that up, because I've had a couple transactions going on right now, and the consumer is completely confused by what's being put out on the internet, because you can look at Bankrate.com and all these other different sites, Fannie Mae's average, and everything is so sensitive to what your credit score is, what your loan to value is, what's your type of property. If you have a condo versus a townhome or a single family, all these things really, play a part. Well, a couple of the people just called in, actually listeners of the show, and it said, I'm just trying to find out where rates are at. And, so I said, well, it's kind of hard for me to just give you a rate when I don't know the overall scenario. So what really happened is I said, okay, well, let's just pretend like your credit scores are 720. Let's pretend that you have a single family. Let's pretend that you've got the documentation and the ratios to support a full documentation loan. And let's pretend all this. So we pretended all of that, and we came up with a rate of somewhere around like 4.375 on a 30-year fixed. Okay? So we did all that, and then after that, she was like, oh, I like that rate. So we went back, and then we actually went through the process of pulling her credit, actually documenting the income and all that. Come to find out, her loan-to-value wasn't as low as what she thought. Her house wasn't going to appraise for as much as she thought it was going to. The end-all was, instead of 4.375, she was looking more at 4.75%. And why that's so critical is because you have consumers out here who are looking to buy a house or refinance a house, and they're taking averages or advice from an internet site that they have never spoke with the person. They don't know what their goals are. They don't even know if they're going to qualify for the type of loan that they think they are. And in the end, it's going to cost them hundreds, if not thousands of dollars more in finance charges, which is better to know way up front. And that's why it's important you talk to a professional up front, because you can kind of, cut that off right at the beginning versus writing a contract on a property and then finding out a month later that you're going to get a quarter or 3/8 higher of interest rate.
Well, Ryan, I'm sure as a professional, you see this all the time. Someone sees something on the internet, whether it's a home value, a rate quote, they'll take that as gospel.
Yep.
They refuse to let it go, even after you counsel them not to.
Absolutely.
Okay, but I saw it on Bankrate, but I saw it on HomeGain, but I saw it on Zillow.
Yep.
And it's very hard to get that first impression out of people's minds, and that they really need to listen to the professional, either the realtor or the mortgage professional, and what they're actually going to get involved with.
Yes, absolutely. And I'm here for that. Anybody that's in that situation, feel free to just reach out to me as a sounding board, because ultimately I'm here to answer your questions, your concerns. I mean, I'm not, I'd love to have your business, but my job is to educate consumers on what the economic indicators they should be looking at. And
you got to remember, Ryan, that the information on the internet, for the most part, is designed to capture the consumer so that they look at ads or they get a call to a vendor.
Absolutely.
It's not there. It's not meant to be the be-all and end-all. It's meant to be a starting point.
Exactly. 877-245-2030. That's 877-245-2030. If you're currently trying to obtain a mortgage, or you're thinking about maybe obtaining a mortgage for a refinance, a debt consolidation, for a renovation loan, for anything, reach out to us. We'll gladly give you a free analysis of where you currently stand, and maybe what give you an option or 3 or 4 options of where you can go. But I think the big thing to take away from today's show is, if you are looking down the road a year or 2 years from now, that you might want to revisit that today, because the interest rates of today will not be here a year and a half, 2 years from now. I can't guarantee it, but I almost promise that that's going to be the case. So 877-245-2030. So, Louis, let's jump ahead to the huge jobs report that happened last Friday. It was obviously a much weaker report than expected. I believe that the unemployment rate rose from 9% to 9.1%, as the economy only created 54,000 new jobs, which is a big stinker. Huge. And the interesting thing in that whole report, I don't have the actual number, but when I was listening to CNN Squawk Box, they had said something along the lines of, I believe that they had lost something like 35,000 government jobs, but of the 35,000, the majority of those were local and state government jobs, not the federal government.
Right.
So, we can see this trend across the country where, the local and state governments are having to cut because they don't have the advantage of having Ben Bernanke's printing press at their disposal. So, this is going to be a continuing trend, and I'm going to keep my eye on it, because I think that this is really a good gauge of where we're headed, as far as jobs are concerned. Wouldn't you agree, Louis?
I'd agree that the states are going to have to continue to cut employees, but at some point, the federal government is going to have to get in on the act and do the same.
Yeah.
And we may see some big changes in the next 2 elections, where you get more fiscally minded representatives forcing the hand of the Congress to cut spending.
Yes, 100%. I believe the same thing. Did you get a chance to catch? I believe it was CNBC, Squawk Box, or somebody had interviewed Alan Greenspan at the end of last week. it was pretty interesting because they were just asking him, where he sees things going, and he didn't have a very good outlook on where we're headed, and was very concerned about what's going on over in Europe. I think it's interesting because the
guy who lit the fire is just complaining about the blaze.
I know, but what I find is interesting is that normally, you would see him find a way to critique what's going on with the Fed and Bernanke, but he wouldn't take any questioning as far as anything that had to do with the Fed.
And he's not going to take any blame either for, setting in motion these policies.
Yeah, for having a policy that kept interest rates low for such an extended period of time that it let prices of homes shoot through the roof.
That's right. And for properly tutoring Mr. Bernanke in the same school.
Yeah, it's definitely there's a lot of irony going on there. I want to give a little insight as to what's coming up this week. We do have a bit of economic data. The Treasury is going to auction off a bunch of notes and bonds beginning Tuesday through Thursday. The auctions most likely will go well as they have in the last few months. However, there is always some concern that should keep interest rates from improving much until the demand for the 10-year note is measured. Now, I always talk about the 10-year note and why that's important. If you do follow interest rates and you're really trying to get an education on what's going on with interest rates, the 10-year note is a good indicator of where interest rates are headed because it just tends to follow that theme. If, the 10-year bond yield is going down, interest rates are typically getting better. So it has hit below that 3% level. It's trending back upward now, but that is a very good indicator, and I'm not sure that that's going to hold. Technically, the rate markets are overbought, and likely they're going to consolidate here for a while. I believe that the stock market opened a little weaker this morning, but interest rates have actually dipped down, I believe, about 30 to 40 basis points. So rates were a little weak as of this morning. I'm going to say once again, I think that we can't continue to hold these levels. We really don't have a good floor of support to continue at these levels. So if you are looking at locking in 30, 45, 60 days or potentially looking to refinance, I would highly suggest you jump on that ASAP.
And Ryan, I would add to that, when QE2 expires officially on June 30th, we're going to get, I think, Fed announcement on the 22nd. We'll get a better idea of what they're planning on doing. If they indicate they're going to do more easing, then we might see these low rates for a bit longer.
Yep.
Somehow they start speaking more hawkishly, although I don't know how they will because of the unemployment situation is not very good and the economy is not really coming back at all, so they really can't remove the training wheels. But if they indicate in any way, shape, or form that they're going to kind of slow down with the easy money, then rates will ratchet up. But my guess is going to be they're in no position to stop with the easy money, so we might see these rates move backwards and zigzag for a while, but in the low range.
Yeah,
they continue to do some form of QE3 or some form of easing. I don't know what it'll be, but they're really, in their philosophy, the economy's not self-sustaining for them to pull the training wheels off.
Yeah, I totally agree. I think that this is going to be much of the same moving forward. Once QE2 expires completely, they're going to have to continue it. I think what's going to happen is that they're really going to have to come out and say, where this money's going, how it's actually going to help versus just throwing more at more treasuries or mortgage-backed securities.
Well, we saw last week, we cited the statistics that basically the number of jobs they created, it cost them $870,000 per job, and then the housing prices dropped 6-8% during the time of QE2. So they really don't have a good track record to say that QE2 works, but their argument is going to be it would have been worse if we didn't spend the money.
Right. What's the alternative, right?
We're going to spend even more. We're going to print even more money.
Exactly. Yep, which is completely backwards there. Well, we're coming up on a break. When we come back, we're going to jump into discussion with Patrick Duffy with U.S. Realty Partners on where the local real estate markets are statistic-wise for Prince William and Fairfax County. Stay right there. You're listening to Real Estate Radio.